Little Child started a new kitchen and bath design business called Little Child Enterprises. The following activities occurred during its first month of operations in March 2017. And we've got 12 transactions. So what we're going to do is use what's called T-charts. No accountants actually use T-charts. It's just a learning tool. But we'll show you how they're done. This is just going to introduce you a little bit to debits and credits. So our first one, now this is called double entry accounting, is what we're working on. So every transaction has 2 entries. All right, we'll go through each one right now. So Little Child invested $160,000 cash and office equipment valued at $20,000 in the business. So this one has a T chart. So we've got cash and we've built a T. You're going to be learning about in Chapter 2, debits and credits, and what makes each account work. So I'll kind of breeze through it, but you'll be focusing a lot more on it in your smart reading. But $160,000 in cash, so cash has gone up $160,000. This is on the debit side, and the left side is debit, and the right side is credit. Cash will be debited $160,000 because debits make assets go up. He also invested $20,000 of office equipment. So is office equipment going up or down? Down. He's put it into the business. Up. Now, finally, what did he had a owner's investments. Now, double entry accounting means that all transactions have to balance. So if there's 160 plus 20, so 180,000 of assets, he invested $180,000. Now, credits make equity go up. Again, this might be a little bit confusing. You're going to learn a lot more about it in smart reading this week. He purchased a small building for $600,000 to be used as an office. He paid $100,000 in cash and signed a note payable promising to pay the balance over several years. So he purchased a building, which is what? Is that an asset?
Yep.
For $600,000. He used $100,000 cash, so we can credit $100,000 of the cash. And signed a note payable promising to pay the balance over several years. So the difference would be $500,000. Purchased $3,000 of office supplies for cash. Purchased $72,000 of office equipment on credit. So I'm going quickly through this. Just giving you a chance just to see what is going on. So whenever you see on credit, you can pretty much always count on accounts payable being the account. Little Child made reservations at a hotel hosting a kitchen and bath design conference in August 2017. He will send a deposit on July 1st, 2017. Is that a transaction in March? No transaction there. Completed a project on credit and billed the client $5,200 for the work. So, completed a project on credit and billed the client $5,200 for work. Credit makes revenues go up because our revenue has just gone up, and our accounts receivable has also gone up because we haven't been paid. Paid a local online newspaper $3,500 for an announcement that the office had opened. Oops. Sorry, debits make expenses go up. Completed a project for a client and collected $4,000 cash. Made a $4,000 payment on the equipment purchased in D. Received $2,500 from the client described in F. Just remember that was the $5,200 accounts receivable. Paid $7,000 cash for the office's secretary's wages. And withdrew $3,600 from the company bank account for personal living expenses. So if you were to add all of these up, sorry, I ran out of room on the cash here. Have remaining, if you add all the debits less all the credits, you'd have, sorry, I'm just going to point. So what you might not understand is the debit credit, why we did what we did there. That's okay. Don't stress about that. That'll be a next week. That will be a next week question.
So debit is like the accounts going up and credit would be going down?
It depends on the type of accounts. We have 5 different types of account, and debit and credits affect all 5 differently.
Oh.
So in assets, for instance, debits do make it go up, credits make it go down. But in liabilities, it's the opposite. Credits make it go up, debits make it go down.
The 45,400 is the difference between debit and credit, the total?
Yeah, so this is a debit balance of 45,400. So the total for this was 166,500 less the total for this, which was 121,600. So this is the difference. So if you add up all the debits and you less all the credits, you'll get this number. Yeah. Again, it's a little complicated right now, don't worry. After you do the smart reading, you'll totally up to speed on it. So, if we were to prepare an income statement, statement of changes in equity, and balance sheet using the format provided, which is this, we can go ahead and do that. So, we are starting with an income statement. What's the first thing that we need to do for the income statement? This is for March 31st, 2017. Out of our 12 accounts, which ones are revenue? Just this one. So we only have one revenue account. And the total for that was? 9,200. And then we have our operating expenses. And how many operating expenses do we have? None here. None here. Advertising and wages. And what were the total for those? 7,000. So our total expenses are 10,500. So what is our net profit / loss? Minus, it's 1,300, right? It's a loss of 1,300. So we can show that by putting it in brackets. So if we were to do our statement of changes in equity, what's the first thing we need to do before we even start it? And So in March, Little Child started a new business. So what will the opening balance be? $0 balance. What do we add?
Investment.
Sorry?
Investment.
Owner's investment. And what is that total?
180.
Are we adding anything else?
What does it say right there, Little Child Capital, the first thing,
George Little Child Capital, March 1st.
before that?
George Little Child.
Oh, George, okay, sorry.
That's all good. So do we adding anything else? No, cash is an asset. This doesn't affect equity. Nope. The answer is no, we're not adding anything else. So we add this up, we have our total. So our opening plus our additions comes to 180,000. What are we less?
No.
Yep, loss. What else? What else brings equity down? What can an owner do to bring equity down? You can take money out of the business, exactly.
3,600.
So we've got a loss of 1,300 and withdrawals of 3,600. Total that up, 4,900. And we get our closing capital. For George Little Child on March 31st, 2017, 175,100. One more.
Balance sheet.
I can't keep up.
It is on camera too if you feel the
Yeah,
need to go
I
back.
know.
Yeah. So we have a balance sheet. What is the first thing we need to do? For that, we gotta put our title down. So we start with our assets. So which one of these are assets? Is cash asset?
Yes, accounts receivable.
Office equipment? Is that an asset?
Yes.
Building?
Yes.
Notes payable?
No.
No. Office supplies?
Yes.
Accounts payable?
No.
Revenue? Accounts receivable?
Yes.
So we got 1, 2, 3, 4, 5. 5 assets. We got total assets of 743,100. Is that what, anyone else add them up? Is that right? Alright, well, we'll find out when we go to balance anyways. Liabilities, accounts payable,
Equity,
not yet, no, what other liabilities do we have? Pardon me? Nope. Draws was in the statement of changes equities, not in the
Notes payable.
notes payable yet.
Like that.
And we get our total liabilities of 568. And our equity, and we get George Littlechild's capital 175 100 and total liabilities plus equity. What do we get when we add these up? I'm gonna and they balance.